Is the seemingly safe foundation of your London home about to crumble beneath you? While estate agents and government officials whisper comforting words about stabilizing markets, a far darker, more catastrophic prediction is echoing in the private offices of London's most sophisticated hedge funds. Experts aren't just predicting a downturn, they're quietly forecasting a property crash so brutal it could erase 20 to 30% of London's average home value, hundreds of thousands of pounds, by 2026. This isn't fear-mongering, this is a convergence of economic forces that precisely mirrors the warning signs preceding the 2008 financial meltdown. Headlines focus on modest mortgage rate decreases, tempting everyday buyers back into the market just as a perfect storm of debt and deflation reaches its breaking point. In the city's most exclusive neighborhoods, like Mayfair and Knightsbridge, luxury properties are already sitting vacant, selling at discounts of up to 40% below their 2015 peaks, a silent, alarming indicator that the smart money is fleeing. What makes this impending disaster so infuriating is the existence of a controversial, yet remarkably accurate, economic theory, the 18-year property cycle. This pattern, which has predicted every major crash for 2 centuries, is now pointing its finger directly at 2026 as the year London's housing bubble finally and definitively bursts. The most shocking truth isn't the certainty of the crash, but that an elite group of investors, the people you trust to manage your money, already know, and they are discreetly repositioning their assets and preparing for the ultimate buying opportunity, while everyday homeowners remain dangerously unaware and over-leveraged. The clock is ticking on this financial time bomb, and the crucial warning signs are hiding in plain sight. What you're about to learn isn't just economic analysis, it's the survival guide that could save you from a financial destruction zone and determine your stability for the next decade. This is the untold story of how London's market got so dangerous, and who is pulling the plug first. This impending catastrophe isn't being pulled from thin air. It's being tracked by one of the most ridiculed yet uncannily accurate economic models in history, the 18-year property cycle. This isn't complex, data-driven quantum finance, it's a simple, startling, almost psychological pattern identified by economist Fred Harrison in 2005. At the time, when he published his book Boom Bust predicting a property crash in 2008, he was laughed out of the room by mainstream economists and financial analysts who believed the market had entered a new era of perpetual growth. 3 years later, as property values plummeted worldwide and the global financial system teetered on the very edge of collapse, nobody was laughing anymore. Harrison's work revealed that property markets follow a relentless 18-year cycle of boom and bust, approximately 14 years of growth, including a mid-cycle slowdown, followed by 4 years of brutal decline. The evidence is compelling, almost unbelievable. Major property crashes occurred from 1989 to 1993, then again, precisely 18 years later, from 2008 to 2012. You can trace this pattern back to the early 1800s with remarkable, chilling consistency. What gives this theory so much credibility is that it correctly predicted not just the 2008 crash, but also the market's resilience immediately following the COVID-19 pandemic. While nearly every mainstream analyst screamed about an immediate post-pandemic collapse, the 18-year cycle proponents insisted the market had not yet reached its cyclical peak and would continue to soar. They were right. Now, Harrison and his followers are pointing a direct, unambiguous finger at 2026 as the year when London property will hit its absolute peak before entering a devastating, unavoidable 4-year decline that could last until 2030. Critics argue that massive government intervention, unprecedented interest rate manipulation, and global events like pandemics make such long-term predictions impossible. Yet, the cycle has persisted through world wars, technological revolutions, and every financial system change imaginable. The pattern reveals a concerning truth about human nature, that as each generation forgets the pain of the previous crash, the same mistakes are repeated. Beneath the seemingly stable facade of London's property market lies a colossal financial time bomb, set to detonate by 2026. This isn't about distant global economics, this is an immediate, localized crisis involving hundreds of thousands of homeowners whose mortgages are set to reset at dramatically, devastatingly higher rates in the next 12 to 18 months. During the era of ultra-low interest rates between 2020 and 2022, the Bank of England's base rate was practically zero. This allowed London home buyers to secure historically low fixed mortgage rates, often as minimal as 1 to 2%. This environment encouraged buyers to stretch their budgets to the absolute limit, taking on enormous loans. The average London mortgage skyrocketed to over £240,000, nearly double the national average. Today, that golden era is dead. The Bank of England's base rate is at a much higher level, and the average 5-year fixed mortgage rate is hovering around 5%. For homeowners whose fixed terms are expiring, the financial shock is immediate, relentless, and potentially catastrophic. Let's put this into the brutal, real terms facing a typical London family. A homeowner who borrowed £500,000 at a mere 1.5% in 2021 was paying approximately £1,900 per month. When that fixed rate expires, the exact same loan at 5% instantly jumps to nearly £2,900 monthly. That is an additional £1,000 per month, or a staggering £12,000 every damn year, taken directly out of a family's already strained budget. This is the brutal reality facing over 200,000 London homeowners by 2026. Industry data shows that a concentrated wave of approximately 70% of all UK mortgages taken out during that low-rate peak were on 2- or 3-year fixed terms, meaning the wave of refinancing is about to break, and it cannot be stopped. What makes this crisis particularly dangerous is that it's hitting homeowners while they are simultaneously grappling with the crippling effects of inflation, energy bills, food costs, and transportation have all risen dramatically, shrinking the financial cushion families might once have had. Even high-earning professional households are finding themselves stretched to the very breaking point. The most concerning element of all is that many of these massive loans were taken out at the absolute peak of the market. If forced to sell in a declining market, which the 18-year cycle suggests is imminent, they will face the agonizing prospect of negative equity, weighing more on their mortgage than the property is worth. Banks are not oblivious to this. Internal risk assessments at major UK lenders project mortgage delinquencies will rise significantly through 2026, with some models suggesting default rates could reach levels not seen since the aftermath of the 2008 crisis. But before the average homeowner even defaults, the ultra-wealthy are already making their silent, calculated escape. For decades, the foundation of London's luxury property market was its role as a global vault, a safe deposit box in the sky for the world's ultra-rich. International capital, Russian oligarchs, Middle Eastern royalty, and Chinese entrepreneurs poured billions of pounds into London real estate, treating it as an untouchable asset. This foreign investment was so substantial that by 2015, non-resident buyers accounted for over 60% of all prime central London purchases, turning areas like Mayfair, Knightsbridge, and Belgravia into showcases of global wealth, often with streets containing more empty, unoccupied investment properties than actual homes. Today, that picture has dramatically, quietly reversed. Data from major estate agencies reveals that foreign buyer participation in London's prime market has plummeted by nearly 50% since its peak. This isn't random, it's a direct consequence of specific, deliberate global and policy shifts that serve as a clear, glaring warning sign for the broader market. The most significant factor is the British government's elimination of the non-dom tax status. This regime allowed high-net-worth individuals to reside in the UK while legally avoiding tax on their worldwide income. Its removal has prompted thousands of the ultra-wealthy to rapidly and quietly relocate their fortunes to alternative, more accommodating tax havens like Dubai, Monaco, and Singapore. Geopolitical factors have amplified this exit. Russian oligarchs now face sanctions, Chinese investors face government capital controls, and Middle Eastern wealth is increasingly favoring global cities with fewer regulatory hurdles. The impact on property values has been dramatic but largely concealed from public view. In the most exclusive neighborhoods, property values have already fallen by over 20% from their peak when measured in pounds. For foreign buyers, who also face currency fluctuations, the decline is even steeper, often exceeding 30 to 40% when measured in dollars or euros. This exodus of international capital matters far beyond the concerns of the super-rich. London's luxury property market was the crucial engine that drove development across the entire city, often subsidizing affordable housing through planning contributions and generating billions in stamp duty. As this luxury market collapses under the weight of oversupply, the entire economic model of London property development is called into question. Developers, facing massive inventories of unsold, high-end apartments, are pausing projects and halting affordable housing contributions. This is no longer just about luxury properties. The contagion is spreading to the broader market as another key domestic player, the landlords who own nearly one-third of London's housing stock, start heading for the exits. This foreign cash was the engine of London property, but it's not the only key player making a run for the exits, and what they're doing next will shock everyone. A seismic shift is underway in London's private rental sector, one that is creating market distortions that point directly toward the coming crash. Experienced, professional landlords are leaving in unprecedented numbers, creating a dramatic imbalance that few are willing to acknowledge. Recent data from the National Residential Landlords Association is explicit. 19% of London landlords sold properties in the past year, while only 8% made new purchases. That's a massive net reduction in rental stock at precisely the time when demand is soaring, a counterintuitive divergence that signals a market nearing its breaking point. Even more telling, a staggering 41% of remaining landlords report plans to reduce their portfolios or exit entirely within the next 2 years. If this happens, tens of thousands more rental properties will flood the sales market by 2026. Why this mass exodus? It's not one single factor, but a perfect storm of challenges that experienced property investors recognize as definitive warning signs. First, soaring mortgage costs have more than doubled for landlords, transforming once profitable investments into cash flow negative properties. Landlords who aggressively expanded during the 2% interest rate era now face negative returns after financing costs, even with record-high London rents. Second, major regulatory changes have dramatically altered the risk-reward equation, most notably the government's plan to scrap Section 21 no-fault evictions. This allowed landlords to regain possession of their properties relatively easily. While this provides important protections for tenants, from an investment perspective, it adds significant risk and complexity to management, making property ownership feel more like a liability than an asset. Third, tax changes have steadily and relentlessly eroded profitability. The phasing out of mortgage interest tax relief and the 3% stamp duty surcharge on additional properties have combined to make buy-to-let investment far less attractive than it once was. The consequence of this landlord exit is a dangerous contradiction. As rental supply shrinks, rents are pushed higher, which gives the illusion of a healthy market. Yet, simultaneously, former rental properties are flooding the sales market, creating a massive supply glut that pushes downward pressure on overall house prices. This dangerous divergence between strong rental yields and deteriorating capital values is a classic pre-crash indicator that appeared before both the 1989 and 2008 property crashes. What's particularly alarming is that this landlord exodus mirrors patterns seen just before previous market crashes. In both 1988 and 2007, there was a similar wave of experienced investors exiting the market while amateur investors, fueled by the fear of missing out, FOMO, continued to buy at the absolute peak prices. This transfer of properties from experienced, cash flow-focused hands to less knowledgeable, speculation-driven owners is the ultimate late-cycle warning sign. It represents a shift from investment based on fundamentals to speculation based on pure, risky hope. The market is screaming a warning, and now the time has come to decide if you will heed it. The evidence is overwhelming. The warning signs pointing to a dramatic London property correction by 2026 are multiple, interconnected, and increasingly impossible to ignore. This isn't a single risk, it's a convergence of crises destined to reach critical mass simultaneously. The 18-year property cycle, which correctly predicted the 2008 crash, is now signaling another brutal downturn. The mortgage time bomb of expiring fixed rates threatens hundreds of thousands of homeowners with a sudden £12,000 a year financial shockwave. The flight of foreign buyers and the mass exit of experienced landlords are adding massive inventory to the sales market while removing its two biggest pillars of stability. Affordability metrics have reached mathematically unsustainable levels, and the most sophisticated institutional investors are already repositioning their massive portfolios in calculated anticipation of the fallout. This convergence of alarming signals does not guarantee a crash, but it increases the probability to a level that demands immediate, prudent preparation regardless of whether the correction proves to be severe or mild. The choice is now yours. For existing London homeowners, now is the time for ruthless financial fortification. If you have a mortgage renewal looming in the next 12 to 24 months, swallow your pride and consider refinancing early, locking in a secured rate now to hedge against future market turmoil. Critically, build an emergency reserve that could cover at least 6 months of mortgage payments and essential expenses. Honesty is key. Assess whether your current property would remain affordable if your income decreased or interest rates rose further. For potential buyers, patience is the only wise strategy. While timing the absolute bottom of a market is nearly impossible, avoiding the likely peak before a correction is an achievable goal. Maintain your liquidity and be ready to capitalize on the opportunities that will emerge when distressed. Inventory hits the market at steep discounts. For investors, this environment demands extreme selectivity and caution. The blanket assumption that any London property is a good long-term investment no longer holds true. Focus only on assets with strong, reliable cash flow that can weather a downturn, and maintain liquidity to seize the generational buying opportunities that inevitably emerge when markets are in financial distress. London has reinvented itself countless times throughout history, experiencing countless booms and busts, yet the fundamental appeal of this global city remains. The warning signs suggest challenging times ahead, but for the informed and the prepared, even property market crashes present immense possibilities for future prosperity. The true disaster isn't the crash itself, but the failure to prepare for it. The choice now, to heed these warnings or ignore them, will determine your financial trajectory for the next decade. So ask yourself, are you preparing for a financial storm, or are you hoping it passes?